I'm predicting the biggest bust in world history is coming. So it's going to be the biggest opportunity of all times because, Kim and I made our fortunes 2008.
Remember quantitative easing when it first came out? Ben Bernanke never said that it was QE1. He just said that it was QE because we weren't supposed to have a 2, 3, and now infinity. What happens is the economy gets addicted to it. So now the economy is addicted to stimulus, government spending, and therefore addicted to this money printing, MMT, whatever you want to call it. So that's what the average investor needs to be cognizant of because they have to adjust their portfolio accordingly. If they don't, then they're really going to have some financial difficulties in the future. What that means is simply there's more currency units in the economy that are chasing goods and services. So there's more dollars.
Fake money. There's fake news, fake money.
The dollar is fake money because it's just an IOU. And to make it more extreme, all your checking account is the bank saying we owe you IOUs. It's like a double IOU, but they're creating more dollars. So it's just simple math. If there's more dollars out there chasing the same amount or fewer goods and services, most likely the price of those goods and services are going to increase. And if prices are going to increase over the next, call it 10, 15 years significantly, you need to have your portfolio set up in a much different way than if prices were to go down or stay the same over the next 10 to 15 years.
The reason I call it fake money is the more the Fed prints money, the rich get richer. We have asset inflation right now. We have asset inflation in the stock market, bond market, real estate market. I mean, it's feeding the rich. So UBI, MMT, quantitative easing, making the rich richer. Unfortunately, the middle class will pay higher taxes because the rich don't pay taxes. But what it does, when you have universal basic income and MMT, the poor get poorer. So if you're a poor person, you can't afford a house now because the real estate prices are so high. And if you have universal basic income, I don't think a bank will touch you, if you want to buy real estate.
Yeah. It's like what was it in the Roman days, the bread and circus? It seems like it's the same thing today with the stimulus checks and the UBIs, that people are getting a couple bucks in the mail and they're thinking that's fantastic. While at the same time, they're not realizing that they're being priced out of every single asset denominated in dollars. They're going to get steamrolled because everything is in a bubble thanks to the Fed, the money printing, and the artificially low interest rates.
And UBI will accelerate it.
That's right.
It'll make the bubble so big it turns into a mania.
You know what's interesting too? You use the word mania. And we hear a lot in the media right now with this cancel culture where everyone is hysterical about everything else. But there's also a lot of hysteria in the stock market, in all these asset classes. So it's like we live in this world where everyone is hysterical about something. It's just kind of pick your poison.
There's capital gains and there's cash flow. And you got to know what you're going for. So in real estate or in stocks or in bonds, people most of the time are going for capital gains. So when a person flips a house, they're going to buy it for 100, goes to 200, they're going to net 100. But the trouble with capital gains is you pay tax on it. But the other part, there's always a boom and a bust. And I'm predicting the biggest bust in world history is coming. So it's going to be the biggest opportunity of all times because, Kim and I made our fortunes 2008 because we had apartment houses and our tenants were leaving to buy their houses they couldn't afford. I mean, there was a thing called a ninja loan, no income, no job. Okay, so there's booms, busts, capital gains, cash flow. And there's a thing called, there's always the opposite. I was at the gym just now, and before everybody came out, I said, I felt for this guy. He says, I've been a bus driver for 40 years. I'm going to retire, and I can't wait. He's turned 65. I said, what do you got? He said, I got a 401k. I said, what's it filled with? He says, oh, I just sold all my stocks at the top of the market. Then I went into bonds. George, what did he just do?
The most stupid thing he could possibly have done. First of all, you should never put all your eggs in one basket, but especially not the bond market right now with all the money printing that you referred to earlier.
You can always hold out hope for an extended sideways movement, but it never seems to arrive. Let me just say, by the way, I have enormous sympathy for participating in a bubble. When I was young in 1968, 69, we had a spectacular mini bubble in tiny stocks, and they all quadrupled and made us rich, and then they all blew up together, and most of them went out of business. And I was just out of business school, and I made a small fortune, almost enough to think about retiring to England. And then in the space of about 9 months, I lost everything back to $2,000 and was lucky to cover my leverage and get out without a huge debt. It was thoroughly exciting, probably the most exciting time I've ever had in investing. So I completely sympathize. Nobody who is young and investing and making money is going to listen to some old codger tell his war stories about when he got wiped out. I get that. So there's nothing that I can say that will cause anyone to change their behavior. The power, the psychological power of a bubble to suck everybody in is prodigious. And we've known that since the tulip bubble. And it will never stop. It feels as psychologically difficult as reinvesting when terrified. They both catch the spirit of the exercise. Well, I would look around and ask the question, what is the least bad? And the least bad is emerging markets. It's a little overpriced, absolutely, but it is at one of its 3 points of maximum difference to the S&P 500. Each of the other two examples worked out wonderfully well in favor of emerging markets. Conversely, when emerging markets was at a peak, which it was in 07, it sold at a premium PE to the S&P. You can have very bad things happen, which they did. But emerging markets is relatively very cheap and pretty much close to fair value. And the other thing is value versus growth. Low growth stocks have been pummeled by high growth stocks for the decade ending in 2019. And then in the year 2020, they had the worst year by far ever. So you had the worst decade followed by the worst year. And the ratio of value or low growth to high growth was also at the co-equal highest, widest it had ever been with 1974. And the outcome after 1974 for value was wonderful. So I would look at the intersection of those two ideas. If you could buy the value stocks in the emerging market universe, which after all you can, and it includes some very high growth potential countries like China, and collectively they will have a higher growth rate than the developed world, almost certainly, and they sell at a huge discount. I would say they are modestly cheap in an S&P world that is extremely overpriced. And you could lock them away for 10 years or 20 years and really expect a decent return, which I would recommend. And since there is no hope of persuading people to actually get out of stocks, that would be the best I could offer. But for those 3 people out there who have a will of steel, I would say also have a cash reserve of 20 or 30%, as much as you can psychologically bear, to take advantage of much cheaper prices sometime in the not too distant future. I would have low growth emerging markets as much as I could stand, and a cash reserve as much as I could stand. And if you had 70-30, 30 cash and 70% cheap emerging markets, that would be a pretty resilient portfolio, I have no doubt. It's about as far away from overpriced assets as you can get for the next 10 or 20 years, though. And emerging markets, incidentally, beat it by 11 or 12% a year compound.